Welcome to another episode of the MRP Easy Manufacturing Podcast. The topic of this episode is production costs. We'll talk about what production costs are, how to calculate them, and strategies to reduce them. Small businesses need to know exactly what each specific product costs to make, not just the factory floor expenses, but everything. Production costs and manufacturing costs aren't the same thing, even though people mix them up constantly. Get this wrong, and your pricing suffers, along with cost control, and your financial statements won't tell you what's really happening. So what are production costs? Production costs are every expense you incur when manufacturing and delivering a product. Raw materials and labor are obvious. However, there are also indirect costs, such as administration, office utilities, logistics, and others, including time and money spent on product design and quality assurance. Production costs go beyond the factory floor. While manufacturing costs cover what happens inside your plant, production costs take a wider view. They include everything it takes to get your product to customers. Most manufacturers track what it costs to build their products. That's it. But if that's all you're measuring, you're missing half the picture. Production costs include general business overheads that eat into your margins. These expenses don't show up on the shop floor, but they still need to be paid and affect the selling price of your product. Understanding the whole cost structure helps you price more accurately so you won't get blindsided when monthly financials arrive. Manufacturing cost versus production cost. Manufacturing costs simply cover direct expenses required to build a product inside your facility. Raw materials, direct labor costs, and manufacturing overhead costs. The latter includes all kinds of indirect costs associated with the manufacturing process itself, such as machine depreciation, plant utilities, and hourly shop floor supervision. Production costs cast a wider net. They include everything in manufacturing costs, plus selling, general and administrative expenses, and research and development. These general costs and overheads occur outside the factory walls, but still need to be covered for a functioning business, and therefore, for your product to reach customers. The accounting treatment matters. Manufacturing costs get capitalized into inventory. They become part of your product's value on the balance sheet. Production costs include additional expenses that hit your income statement as period costs. That difference affects how you track profitability and report financial health. Now, let's look at the different types of production costs. Costs don't all behave the same way. Some stay steady regardless of production volume. Others move up and down. Understanding these differences helps you manage costs more effectively and make smarter financial decisions. Fixed costs. No. Fixed costs stay the same no matter what your production process's outputs look like. Make 10 units or 10,000. Your rent doesn't change. Neither do salaried labor, equipment depreciation, or insurance premiums. These costs are predictable, but they still impact pricing and profitability because they get spread across every unit you produce. It's important to know the total fixed costs, regardless of the level of production you manufacture. Variable costs. Variable costs move with your production volume. Make more units means you're spending more money on raw materials, packaging, storage or shipping, and hourly labor costs. Variable costs directly impact scaling decision-making and forecasting accuracy. When you're planning production runs or building budgets, these numbers need to be accurate. Average cost. Average cost, or unit cost, is straightforward. Divide your total production cost by the number of units you made. That's what each finished product unit costs on average. You need this number for pricing decisions and margin analysis, particularly when comparing different product lines. Marginal cost. Marginal cost shows what one additional unit costs to produce. This matters because if you can make and sell one more unit for more than it costs, you should probably do it. But watch for spikes. When marginal costs jump due to overtime, rush orders on materials, or capacity constraints, that's a signal to reconsider your approach since the overall cost per unit increases. Here's a quick look at how the aforementioned cost types can converge when calculating production costs. Let's say a bicycle manufacturer produced 400 bicycles, which incurred $65,000 in variable costs, along with the fixed costs of $15,000 per month. That means the total cost of production is $80,000. The average production cost per unit would then be $80,000 divided by the 400 bicycles produced, which equals $200. As a production capacity increase would only affect variable costs, the average variable cost per unit in this scenario would be $65,000 divided by 400 equals $162.50. That means producing one more bicycle would cost an extra $162.50, which is noticeably lower than the average cost. Let's say the manufacturer is thinking about producing 500 units next month. Thanks to ordering more materials, the supplier offers the company a discount. This leaves the company with a projected total cost of $95,000. The marginal cost in that case would be change in costs equals $95,000 minus $80,000 equals $15,000. Change in quantity equals 500 minus 400 equals 100. Therefore, the marginal cost would be $15,000 divided by 100, which equals $150. Therefore, it would be economically viable to produce more bicycles as long as demand remains. At some point, however, the marginal cost curve will turn upward, and each additional unit becomes more expensive to produce than the previous one. The takeaway? Either raise your selling price or reduce the volume of production in order to control costs. Now, how should you calculate production costs? You need to know your numbers to make good financial decisions. Pricing, production planning, profit margin management, all of it depends on accurate cost data. Three metrics matter above all: total manufacturing cost, cost of goods manufactured, and cost of goods sold. Get these right and you'll understand what's really happening with your costs. Total manufacturing cost, or TMC. TMC equals direct materials plus direct labor plus manufacturing overhead. This is the foundation. Everything spent inside the factory walls to produce goods: steel, machine operators, electricity that powers your CNC line. In other words, items used in or because of your manufacturing process. Manufacturing cost isn't just a BOM and direct labor hours. It includes waste, downtime, and root inefficiencies. Cost of goods manufactured, or COGM. COGM equals TMC plus beginning work in progress inventory minus ending work in progress inventory. COGM shows the total value of goods you completed during a period. It adjusts for work in progress, so you're measuring only the total number of units that were actually completed. This matters most for job order or batch manufacturing, particularly when work carries across multiple accounting periods. The final metric is cost of goods sold, or COGS. COGS equals COGM plus beginning finished goods inventory minus ending finished goods inventory. COGS represents the cost of everything you managed to sell in a fiscal period. It connects the production floor to the income statement, making it one of the most watched metrics in your financials. Accurate inventory tracking and cost allocation are essential for valid COGS reporting. Strategies for reducing production costs. Reducing production costs means finding manufacturing waste and eliminating it. These 5 strategies can give you the best return. First, tighten up the manufacturing process. Process waste cost money. Lean practices like 5S, sort, set in order, shine, standardize, sustain, or value stream mapping help you cut excess motion, scrap, and setup time. Value stream mapping often reveals that products spend most of their time waiting between operations, not actually being worked on. Look at your bills of materials and yields as well. If your BOM calls for 10 feet of steel, but you're consistently using 10.5 feet, that extra half foot is disappearing somewhere. For example, offcuts, measurement errors, or poor nesting. It's not contributing to your product, but it still eats up raw material budget. Start with your highest volume products or most expensive materials. That's where waste hurts most, and small improvements add up fast. Make improvement part of the job. Cost-cutting campaigns fade because they come from the top down and end when the pressure lifts. What works is weaving continuous improvement into your culture. It sticks because it comes from the people doing the work. Look for ongoing savings that are sustainable in the long term. Kaizen, Six Sigma, or even a simple suggestion program gives your team ownership and generates ongoing savings. A machine operator who spots a recurring setup issue can save more money in a month than a consultant's report gathering dust on a shelf. When your employees feel a sense of ownership, they begin looking for ways to improve the process on their own. Start small. Weekly 5-minute team huddles where people share one thing that slowed them down. That's enough to get the ball rolling. Track real costs, not estimates. Estimates hide problems. If you're pricing products based on standard costs, you might be leaving money on the table or losing it without knowing. Standard costs from last year don't account for this year's material price increases, wage adjustments, or efficiency changes. The gap compounds over time. Track actual material, labor, and overhead costs. Actual cost tracking means capturing what you really spent, not what you budgeted. Every material purchase, every hour logged, every utility bill allocated to production. Create a clear, complete list of manufacturing costs and document it. That's how you see what's really happening. Review your cost standards at least quarterly, but monthly is even better if you're in an industry with volatile material prices. Cut overhead where it doesn't hurt. Production costs include more than the factory floor. Look at administrative expenses, marketing and sales costs, and other overheads. That approval workflow that touches 5 people before a $200 purchase order goes through, that's an overhead cost. The 3 different systems your team uses to track the same job? More overhead. Take a step back and look at your system. How and what kinds of workflow processes can you streamline further? Eliminate steps that don't add value. If someone reviews a document just to pass it to the next person without making decisions, that's a step you can cut. Maybe you can also consolidate some supply chain vendors, reduce redundant approval cycles, automate order tracking to enhance access to sales data. These extra operating costs eat into margins just like material waste does, but they're easier to overlook because they aren't always immediately visible. Small inefficiencies compound. 10 minutes of unnecessary meetings per person per day equals 40+ hours of lost productivity per employee per year. Finally, use software that shows real numbers. As useful as spreadsheets are, they often limit access to relevant insights. They break down when multiple people need the same data. Version control becomes guesswork. By the time you reconcile 3 different Excel files, the numbers are already outdated. Manufacturing software tracks actual costs as they happen: materials, direct labor costs, and overhead. When you can see real numbers instead of estimates, you make better decisions faster. Should you accept that rush order? With real costs visible, you know instantly whether overtime and expedited materials will kill your margin or if there's room to make it work. Real-time cost tracking means spotting problems while you can still fix them. A material cost spike is instantly reflected in your finances, not 3 weeks later when you're already committed to customer pricing. You can calculate the total production cost accurately during the workday. Control your production costs with MRP Easy. Most manufacturers don't know their true production costs. They're working with estimates and spreadsheets, guessing at margins. That creates problems when you need to quote a job or figure out which products actually make money. MRP Easy can automate cost tracking and provide real-time access to your financial data. It's built for manufacturers and distributors who've outgrown spreadsheets but don't want a massive ERP system with 6-figure implementation costs. The software includes a built-in standard accounting module and syncs natively with Xero and QuickBooks. Think accurate, one-click cost and lead time estimating based on real manufacturing data could be helpful. Knowing how much a product actually costs to manufacture is one of the biggest advantages an ERP system brings to a small manufacturer. When you can see a product's real cost before you ship it, pricing gets easier and so does cash flow management. You stop guessing and start working with real numbers. That wraps up this episode of the MRP Easy Manufacturing Podcast. Thanks for tuning in. For more information, go to mrpeasy.com. See you next time.